Hey, welcome to this month's market update, everyone. I want to give you a quick update on what's going on here in Orange County, housing market in general, because there's a lot of scary headlines and just a lot of uncertainty. So let's clear some of this stuff up. All right. So first of all, there's all this talk about an upcoming recession. When it's going to happen, who knows? But first of all, let's define what a recession is. Recession is basically the GDP, the gross domestic product, everything that's produced in the country decreases for 2 consecutive quarters. Okay, so the economy kind of gets a bit smaller. Now, there's something that has to be cleared up. Recession does not equal housing crisis. I think this is the reason why most people get confused about this is because 2007 was the biggest recession we've had recently, and this is the one thing that most people reference back to. But as you'll see in the chart, most recessions, the houses still go up. The house values are not directly correlated to what the economy is doing. 4 of the past recessions, house prices went up. The 5th one just went down right under 2%, which really not that significant. So other than 2007, home prices have continued to appreciate even during a recession. Okay, so with that being out the way, let's also clear up some facts why this housing correction is not like 2007. Okay, this chart shows you the amount of loans funded in billions that were people had a credit score of under 620. These are subprime loans. Subprime loans and subprime lending practices were primarily the reason for 2007 and the bubble that we had. So this is not the case. People have much better, there's a lot more stricter guidelines on underwriting for loans. The average credit score, I think it was 725 or something for people getting loans now. It's significantly better. Okay, so lending guidelines and lending practices are completely different than 2007. Number 2, the amount of equity that people have in their homes is significantly higher. What's called tappable equity is the amount of equity that you can pull out of a home and still have 20% equity in the home. The tappable equity in 2007 was about 5 trillion. And we're talking about the US. We're not talking about Orange County. 5 trillion. Right now, today, it's 11 trillion. So there's more than double the tappable equity that people have in their homes. So they don't have to sell. People will not have to be selling. And by the way, a lot of the loans that were happening in 2007 or leading up to 2007 were adjustable rate mortgages. So the rates were not fixed. They're not 30-year fixed. So people had to sell or refinance by a certain time. Most people don't have that now. So that's the second thing. Third thing is the inventory is completely different today versus 2007 at the height of, the bubble. Right now, we're in Orange County. We are sitting on around 3,500 homes on the market. Okay. In context, also, in 2019, we were at about 7,500 homes on the market at this point. So we're still below the regular levels in Orange County, but also compare that to 2007 when we had 18,000 homes on the market. So it's extremely different, levels of inventory that dictate also how prices go. And one final thing is 37% of people have their houses completely paid off. So it does not really matter what their house prices are. They will not be selling. They do not need to sell at any point. Or even if they do, the prices are kind of insignificant. So 37% of people paid off, no mortgage whatsoever. Now, let's talk about the current demand and activity and days on market. So demand is down 56% versus last year. That's primarily because of the interest rates. They're significantly higher than last year. But also, there are, even beginning of this year, when the interest rates were still not as high and they were still going up and there was a ton of demand for homes, the numbers versus last year were lower. And that's because there was less homes on the market. So overall, the number of sales that are going to happen this year are going to be less than last year. But demand is definitely down versus last year. It's down 56%, as you'll see in the chart. This is affecting the days on market. So the average days on market here in Orange County now stands at 56 days. That's still a seller's market. It's not a crazy seller's market. Now, for context, in March, the average days on market, March of this year, was 19. So 19 versus 56, it's almost triple. So homes are staying on the market 3 times as much, but it's still a seller's market. It's going to continue going up as the inventory goes up and demand goes down. So that's going to balance out. And towards the end of the year, we're going to be either in a balanced market from a days on market standpoint, either a balanced market or a somewhat buyer's market, a slight buyer's market. So we'll see how that goes. And we'll also see how that affects prices. You'll see a lot more price reductions recently, but that doesn't mean the prices are going down. It just means the buyers are not willing to pay a premium versus previous comps. So we will have a clearer indication of what the prices are going to do. Are they going to go down or not in the next couple of months when we see new listings closings? Because the things that are closing now were in escrow 30 or 45 days ago, which was a different market. So we will get a better indication on what the prices are going to do, whether they flatten out, continue going up at a slightly lower rate, or dip down in the next 2 to 3 months. That will happen. So overall, it's still a strong market. If you are a seller, I think now more than ever, you need to price correctly, make your house look good. There's a lot more that goes into the listing strategy versus take a few pictures and review 30 offers. That's not the market we're in anymore. Things are staying on the market and you need to be cognizant of that and prepare accordingly. If you're a buyer, there's definitely more to choose from. So that's good for you. The interest rates are up versus beginning of the year, and they're expected to continue going up throughout this year, maybe next year too. So I would say, look at what's out there, buy something. You will get a chance to refinance. Rates are going to go back down at some point. Expectations are in the next 18 months or so, 18 to 24 months. So, but who knows, right? But they're going to go down. That's for sure. It's going to happen. So you will have a chance to refinance. Look at what the market is now. You can negotiate. Doesn't mean you can lowball offers. Doesn't mean you can, people are not giving their properties away, but at least you have options. I hope this was helpful. Reach out to us if you have any other questions, and I'll see you next month.